Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about picking up the pieces. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So in this video, really, I'm going to give a summary to all of the things that I've spoken about in my previous videos, also prior to the tariff drama, because I think it's important not to lose sight of where we were before the tariffs. And I've decided to start to have the yen in front of everyone's eyes, because I think this is potentially, it is dubious speculation at best, but I do believe that this could be a key area, and I will be speaking about it later on in the video. The first place I want to start is economic data. All right. So one of my first videos, if not the first video I made about where I spoke about being long bonds, I started off by pointing out the quits rate, and how the quits rate really is a survey of the overall labor market, without the additional noise that is associated with surveys like the University of Michigan or the Conference Board Consumer Confidence Survey. Because again, a lot of what you saw, like for example in inflation expectations as they moved up in the last few months, was really a consequence of the fact that Republicans were basically expecting, the merry land of Oz, really. And the Democrats were expecting Weimar Germany in regards to inflation. So you had, and again, because Trump got elected, that is basically the gist of it. And so what you had on these surveys was inflation expectations just break out to the upside. A better way to look at what people are feeling and how people are feeling, in my opinion, is the quits rate. Because the quits rate, what is the quits rate? The quits rate is basically a measurement of how many people are leaving their job on a voluntary basis. And why would that be? Why could you consider that a survey? Well, think about it. If people are leaving their jobs, their own job, the safety of their job, voluntarily, what does that mean? It means that they are confident. It means that they see abundance in the economy. And it means that people feel comfortable leaving their job in order to chase higher wages. That is true when the quits rate is at cycle highs. When the quits rate is at cycle lows, like it is right now, it means exactly the opposite. All right, people are no longer feeling confident, and they're treating their job as, they're trying to really protect the safety of their job. They don't really feel comfortable leaving their job because they know that they might not be able to find a job if they quit their current job. So that's how you should read the quits rate. And for the overall economy, what does that mean? Well, if people aren't chasing higher wages, that will likely feed into wage growth being slower, which will feed into consumption, which will feed into potentially lower inflation and slower growth. And one of the reasons why I pointed out the quits rate is precisely because there is a fairly nice correlation between the quits rate, again lagged by a bit, but there is a nice correlation between, again, the quits rate and inflation at the headline level. And it was my assumption back in February that the uptick that we saw in inflation was, again, potentially a consequence of the quits rate being sticky around the 1.9 to 2%. And that was a consequence of the fact that overall, we do usually see some seasonal stickiness. All right? I called it a seasonal bump, if you recall. We saw it in 2023 when the quits rate stayed stayed flat. And the reason for that is that, think about it, from say the fall till end of March, more or less, that's the holiday season. It's when people get their end of year bonuses. It's when people spend the most because they travel, they go out to eat, they spend money on gifts, and people are just feeling better about themselves because it's just the holiday season, right? On average. The same is true for this year, for the year that just finished, 2024. But on top of the holiday effect, we also had other things come into the equation. Meaning, port strikes in end of August, beginning of September, the potential for port strikes, natural disasters, and tariff front running, which all combined, probably, in my opinion, as I've been saying in my previous videos, probably helped the economy look a bit better than it was, and inflation look worse than it was. And it was, again, my expectation to see the inflation rate roll over as we would go through the year, really. As we get closer to the summer, my expectation really was to see the inflation, at least on the headline, move lower. Now this is kind of bugging out. Let's see if it updates. But in any case, this is at 2.4. All right, the current numbers came out today. Here we go. Yeah, inflation. 2.4. I'm right. This is the core. So today's numbers came out very, very cool. All right. Headline inflation came in at 2.4. Consensus was for 2.8, and the previous number was 2.8. Right. 2.6 consensus, 2.8 previous number. Core inflation came in lower. Overall, it was a solid inflation rate. It's the good kind of news that you want to see when it comes down to inflation. However, something that I spoke about, I don't think I spoke about it yet in yesterday's video. I really don't remember when I did, but I'm certain I did. The problem with inflation going down this much is something that we saw happen last year around June. With the June inflation report, there was it kind of started to get things moving again, like bonds, for example. Let's get this to candle chart. All right, right here. This kind of report right here was toward disinflationary. That was the way a lot of market participants interpreted it. Because think about it, if inflation is cooling but not plummeting, it means that there is still economic activity. If economic activity is just falling off a cliff, and inflation is falling off a cliff, that is the bad kind of disinflation. You're looking at undershooting potentially. So keep that in mind. Just so I don't, my ego doesn't get too big. I will mention something I mentioned yesterday, that if we were to get, inflation coming cooler, I could easily see that being a tailwind for things like the 30-year bond, potentially start to move a bit lower. That is not what we've seen. All right, we continue to see selling pressure on the 30-year and 20-year and 10-year, although the 10-year arguably is suffering a little less. Now, this is where I get into a part of the video which I will put out a disclaimer. I'm going to say things that will probably sound ridiculous. And as I said yesterday when I made the video about, this move right here, I said that basically, I could have published the video and 15 minutes later we were at 6% on the 5-year, on the 30-year yield, and that video could have been irrelevant. But I'm going to say things that might sound ridiculous, but again, I'm fairly okay with taking that risk, and we can all come back and laugh if it actually it turns out to be they turn out to be ridiculous statements. But in any case, if you've been following my videos, I've been making the parallel between 06 and 08 and what has occurred on the 30-year yield from 2022 till today. All right. So just to go over things, all right. The idea is you have a first move up, consolidation, a noisy move up, significant up move, followed by just basically going sideways, play of catch up, W formation or shark pattern, whatever you want to call it, and then the pattern follows through. This is what happened in 2006 and 2008. You have a first rally up, pullback, noisy way up, sideways action, first top followed by W formation. And if, again, my general expectation when I was speaking about this is that I wasn't expecting it to play out 1-for-1, all right? Nothing ever plays out 1-for-1. But if we were going to follow this kind of playbook, I pointed out how potentially we were in this kind of area right here around the August of 07, meaning that we were right here. All right, so last week we had, the week of March 24th, we had peaked our heads above the bull market support band and got rejected. Now, the anomaly right now is, and what everybody's rightfully talking about, is this huge candle that we're seeing right here. All right, this is a problem. It is a problem not because it's not following the playbook, but it is a problem because we are in a risk-off environment. And the playbook tells you if you're in a risk-off environment, treasury bonds, especially the long end of the curve, should act as the safe haven asset. And therefore, yields should be plummeting. I mean, this candle should be just the opposite. It should be a huge red candle if you're following the textbook. All right, we should be back at the very least at August and September lows, given also the fact of the move that we've been seeing in oil. Oil has broken down. We are below $60 now. This could easily just go back above $60 as it went yesterday. But again, just staying focused on the 30-year bond, everything is screaming risk off, and yet we have a move of about 40 basis points, which is huge. And again, the gravity of it, and what makes it so unnerving is the fact that it comes at a time that is supposed to be risk off. It is precisely this kind of environment that the 30 and 20-year bond are supposed to serve. All right. Now, in yesterday's video, I pointed something out, and I don't even know if I'm right. And honestly, I don't think anyone knows if they're right. And I'm fairly okay with looking ridiculous in an hour's time or 2 days' time. I don't know. I'm fairly comfortable with that outcome. Yesterday, when I woke up and I found myself confronted with this huge red candle, red if you're looking at prices and green if you're looking at yields, my memory went back to when I started off in crypto. And, I looked at things like altcoins, because I really just played around with altcoins a lot. And when looking at single altcoins, I remembered there being exactly this kind of huge candle like this, or on the upside, or on the downside. And usually what followed was, so and so just got liquidated. And basically that what I said in yesterday's video is, what if, and again, I don't want to get into the memes of it all, or like, oh, I'm hearing some part shop got blew up, and just like I'm hearing rumors, but because I simply don't know. I absolutely don't know. This is just me going on gut instinct at this point, which could easily be wrong again. But if it were forced liquidation of safe haven assets, which comes at times of increased and of great stress in financial markets, what could it be? And first off, what could it be? Second of all, have we ever seen anything like this before? And the answer is yes. Funnily enough, 2008 comes back to help us out, because during 2008, a few things happened. If you haven't followed history, just a few things happened in 2008. So, again, if you absolutely knew nothing about 2008, and I told you that Bear Stearns collapsed in 2008, and Bear Stearns was involved with mortgages and and so on and so forth, and that caused an incredible amount of pain. And you had, and I'd asked you to point, where is it that you think, when did Bear Stearns collapse? You could have easily perhaps guessed it, maybe right here, right here, because that's where Bear Stearns collapsed. The economy just started rolling over, and so it was just forcing everyone to buy the safe haven asset, because everyone was just running for the hills. Or perhaps you might say, this is Bear Stearns right here, it's just game over. But in fact, when Bear Stearns got liquidated, it was the 17th, the week prior to March 17th, if I'm not mistaken. It was around the 16th or 18th, something like that. But in any case, the collapse of Bear Stearns marked the low point, the local low point for the 30-year yield. And what followed that was a 64 basis point increase on the 30-year yield. 64 basis points. Now, this is one example, and actually there is another example of a dramatic move, which is the collapse of Lehman Brothers. And again, if I had to ask you, where is Lehman Brothers? Maybe it's up here, maybe it's here. No, Lehman Brothers is right here. All right, it's September, middle of September. And granted, we had, just a small pop, yields declining for the immediate future. From September, which was really the collapse of Lehman Brothers, we had a 34 basis point increase on the 30-year yield. And again, this comes at a time where the world is about to end. Right? This is the end of capitalism, as they say in The Big Short. This isn't a time where you want to be selling the 30-year bond. This is a time where you want to be buying the 30-year bond, because it's, and growth and inflation expectations are plummeting. If you go and look at what inflation was doing, we've spoken about this many, many times. If you want, you'll know it if you watch my videos. This right here, inflation was at 4.9 in September. By the time January comes around, inflation is at 0. All right, and what followed that is deflation, actual deflation. So again, coming back to today, could this be forced liquidation and just someone, I don't know who, I'm hearing rumors, again, as the meme goes, potentially having to liquidate bond holdings because they're trying to come up with dollars. They're trying to come up with liquidity at a short time's notice. Could it be? Yes. Could it not be? And could yields go up to 6.5%, 7%? Maybe. But again, I caution everyone not to feed into the doomers too much because, again, I defer to what I would hear in relation to Bitcoin in 2022. Things like, if the internet goes away, Bitcoin is doomed because you can't access Bitcoin again. And to that I would always say, yeah, but if the internet goes away, think about what kind of a world we're living in, right? Think about the things that would make the internet go away. That kind of a world, you're not thinking about, bonds and stocks and crypto. You're thinking about buying a piece of farmable land, making sure you have a clean water source and a shotgun to defend everything, right? That's the sort of stuff you're thinking. And arguably, the idea of 7% or even 10% yields on the 30-year or on bonds in general, to me, just sounds, well, basically we're all becoming an emerging market, and something terrible has happened. And at that point, again, kind of what I was saying about Bitcoin, you're not really thinking about stocks and bonds. You're thinking about something else, likely. All right. At that point, I would imagine that it's just complete meltdown. Everything's melting down. So before you feed into the doomers, maybe they're right. Maybe this is the time that being an actual doomer is the correct thing to do. But it is important, in my opinion, to remember that although the present seems daunting, we are not unique. And we have seen this sort of movement play out, for example, in 2008. And this is where I bring it back to the yen. The yen is something I've been talking about, not too obsessively, because again, in the back of my mind, I always thought that because I was making videos, it was probably the fact that I was making videos was an indication of how overblown things potentially were on the yen. So I didn't really want to make it my main purpose of the channel. But I did speak about the yen. Now, what feeds into the idea that potentially we're seeing forced liquidations, and potentially it's coming because of perhaps something in Japan playing out, is because, well, the selling that we saw starting in the beginning of the month really happened at night. Really, I live in Europe, in case you haven't caught up yet. I live in Europe, so Asian trading times. This is where you really started seeing all of the selling, and what happened between the night of Tuesday and Wednesday, which seems a month ago. I mean, for everything that has occurred. But in any case, it was just yesterday, we saw more of the same. Selling during Asian trading hours. The second and really most peculiar thing, in my opinion, and that really makes me believe that perhaps it is Japan. Perhaps. I mean, I have just as much of a clue as you do, mate. So I'm just speculating at this point. The second thing that makes me point towards Japan is the fact that although the relation with the yen and the 30-year bond has broken down because of the price action that we've been seeing, again, you can see it right here. In purple is the 30-year yield. The yen has continued its move down, okay? And along with it, stocks have continued their move down. What hasn't broken down so far is the relation between the yen and US stocks. Yeah, that was meant for dramatic effect. Thank you. Let's get that back right up. So the yen and the QQQ. Here we go. So this really hasn't broken down. Okay. So again, to reiterate, I would fade the doomers, whether you're talking about equity doomers or bond doomers or whatever. And I would continue to keep an eye on the yen. What helped, in my opinion, well, not really my opinion, it's probably just fact at this point, to aggravate the move that we've seen in the yen today, is actually the inflation data, all right? Because again, what is feeding into the yen? Well, what feeds into exchanges, foreign exchange? Well, what we talked about is the fact that if you have US interest rates at the highs and Japanese interest rates at the lows, the idea is that anything that can move that will make really the interest rates move, well, really converge between the two, meaning either growth collapsing on the US side and therefore you're in inflation collapsing, or inflation being more of a problem on the Japanese side, and so, rates having to go up. Anything that makes these two really converge would act as a tailwind for the yen. So what we saw today really kind of gave it that extra push, in my opinion. And I wouldn't be surprised now while we're at it, to check actually. When is it that we got the right sell-off? It was kind of right here, if I'm not mistaken. What time is this? Right here. This goes 2 hours back, so I would have to look 2 hours back. Right here, this is where we saw the yen kind of, this right here, the yen kind of got an extra kick just as inflation came out. Okay, so again, this really what I'm leading to now is back to the 30-year yield. All right, because, and this is really the ridiculous point of the video. If I'm correct, and this is forced liquidation, because just something breaking in Japan potentially, because of the yen carry trade unwinding potentially, this is actually something you have to look through, because what follows this and this on the 30-year yield is this and eventually this. Yields going where they have to go. All right. So what am I saying? Is yields blowing out bullish? In this case, potentially yes. As ridiculous as that sounds, I know it sounds ridiculous, and we can definitely come and laugh when we're all defending our farmland and and drinkable water, and enjoying our canned tuna and canned corn. But and this really is kind of the optimist view, because I would much rather live in a world where the 30-year goes to say 2.5, rather than live in a world where the 30-year yield is going to 7.5 and 10%. All right, because at that point, given everything we know, something funky is going on. And, it's kind of, again, the parallel I draw with, the anti-Bitcoin rhetoric of, what if the internet goes away? Yeah, if the internet goes away, you're not worrying about, stocks and Bitcoin and crypto. You're worried about something else, which is worse, something worse. All right. So again, I still maintain the outlook that potentially, now it doesn't have to happen this week. I don't know when it could happen, and if it actually does happen. But I'm just thinking that perhaps this candle just reverses course. If indeed this has been caused by forced liquidation and just people trying to come up with dollars at a short time's notice, okay? Which again would feed into the idea of really something that we saw actually in 2008, all right? The Bear Stearns collapses, that doesn't push yields lower, it pushes yields higher because of stress in the system, okay? And it doesn't push yields higher by 5 or 10 basis points. It pushes them up by 64 basis points. And even after that, with Lehman Brothers, it pushes them up by 40 basis points at really the climax of the great financial crisis of 2008. But again, what followed that was this: yields going where they have to go. So I'll leave it at that. Really, this is either one of two things, and again, could be just be the third thing, which is just rates keep steady here and they don't move. But it's either the end of the world, and then yields are going to 6% or 10%, 20% because the US is insolvent and the bond market is illiquid, and all the doom posting that we've been reading about, the bond market, or it's something else. Something that is still bad, but not the end of the world, meaning potentially the unwind of the carry trade, of the yen carry trade, which would lead to this continuation. So I'll leave that up to you, what to believe. If this is just a sign of increased stress in the system, like we saw in 2008, or if it's the end of the world. I mean, personally, I'm not buying into the end of the world just yet. If I see reasons to think about the end of the world, I probably won't be making videos about finance on YouTube. I'll have other priorities at that point. So, again, I think that there are a lot of things to consider, and just the cherry on top are credit spreads potentially, because again, if this is stress in the system, expect credit spreads to keep on widening. All right, keep spreads just blowing out, which again could very well be the top. Although I'm not expecting it to be the top, but let's see how things play out. So far, stocks even today aren't really having a great time, considering even that yesterday we had a sizable bounce, which again, I tried to tell you that yes, it was a significant bounce, but the fact of the matter is that, and now I'll move on to kind of the stock side to really finish the video. I know I'm stretching it out more than I'm supposed to, but one of the reasons why I was quite cautious about yesterday's bounces, because just answer the question, ask yourself the question: have we resolved the underlying issues in regards to tariffs, in regards to some sort of initial benign form of fiscal tightening, and the yen carry trade? Have we resolved all of that stuff? No. While yesterday's announcement of a delay of 90 days was certainly welcome news, at the end of the day, we still have a 10% tariff on everything. We still have tariffs. And on top of that, we have 145% tariffs on China, which is the elephant in the room, in my opinion, at this point. You really have to I mean, really, that is still something that is lingering around, and we'll see how things evolve. Again, even on the stock side of things, I'm of the opinion, and I spoke about this in my previous videos, that even though we're seeing the worst possible outcome, and we saw the worst possible outcome on April 2nd, with, kind of the maximalist approach, my expectation is that we're going to get to cutting deals, both on the EU side and the Chinese side. Something that could easily fix, say, this fixation that Trump has with trade deficits. Make a deal for imports of, say that the trade deficit with the EU is, I don't know, I'm going to just say something ridiculous, for example, 150 billion, give export 200 billion of LNG. You fix the deficit and everyone's happy. Trump gets to say, see, I fixed the deficit. And, you just avoid Armageddon. And at the same point, at the same time, the EU, they kind of pull them away from Russia. And you move them back close to the US. And you give... you kind of you draw the picture where the US and the EU face China together, which is something that I spoke about, again, in my previous videos, which, again, that was my base case. And it's actually something that Besant, I think, if I'm not mistaken, actually mentioned either today or yesterday, the fact that at the end of the day, a deal making deals with the EU will just allow the US to have extra leverage when it goes against China. So again, have things fundamentally changed? Not really. So I would still be cautious. All right. Cautious does not mean doomer. All right. Whether you're on the stock side of things or on the bond side of things or whatever it is you're in, try to keep a level head. I know it's difficult. Is it easy? Absolutely not. Because you have 1,000 reasons to believe doomer postings, especially when you're in abnormal times. The problem with these abnormal times, in my opinion, is that because they're abnormal, you're even more tempted to believe abnormal theories. Because again, it just seems to fit. We're in abnormal times. And therefore, again, why not believe that it's the end of the world? But again, as history shows, whenever it's the end of the world, stocks usually price that in. And so the end of the world is actually the best buying opportunity. So we'll see if it's Armageddon or if it's actually just stress in the system, something that we've seen in 2008. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. Again, thank you to everyone that has subscribed. Thank you to everyone that has commented and liking my videos. All I can say is thank you. Bye.